Section 1 is about the principles of absorption costing. Full absorption costing means that we're going to charge all of our production costs to our units, and we're going to do that for profit reporting, so in our cost of goods sold, and also for our inventory valuation in our statement of financial position. These costs include variable costs such as direct materials, labour and variable production overhead, but importantly they also include an element of our fixed production overheads. Now, the International Accounting Standard number 2 that deals with inventory valuation requires us to put an element of fixed production overhead into product costs so that we can reflect their full cost for those inventory valuation purposes. So if we want to comply with accounting standards, then we do have to comply with the principles of absorption costing. So let's just say we want to calculate the full absorption cost of a compact disc. We've got a cost card and we've already managed to assign our prime cost to it. So our prime cost is all of the things that we can directly attribute to the CD. So we've got our materials, we've got the CD itself and the box, we've got some labour and some direct expenses, which are the royalties that we're going to pay to the artists. What we can't do very easily though is we can't assign these indirect production costs. So we've got a question mark there. We need to put those on so that we can actually get to our full production cost. So we're going to look in the next section at how we actually go about getting to that indirect production cost figure. And that's going to allow us to find our total production cost and eventually get to our selling price. So let's have a look at this diagram. What we've got are all our production costs, and first thing we're going to do is split them into two categories. We've got our direct costs and our indirect costs. Now the direct costs then give us no problems whatsoever. We can work out those and put them straight into the cost card, which is what we've done. So they've already been dealt with. It's the indirect costs or the overheads that give us the problem. And we're going to use a 3-stage process in order to actually deal with these. The first stage is called allocation. What we're going to do is find any overheads that we can directly allocate to different departments or cost centres within our business. Let's just say that Department A and B are both to do with production. So units of production or CDs actually go through units A and B, but Department C is a service or a support department. Now we might have some costs that we can directly allocate to one of these only, and we're going to do that to start with. Once we've done that, we're going to apportion other indirect costs over the cost centres that we've got, and we're going to share those out using some fair basis. So let's look at those first two stages first. So we've got some overheads. Say total overheads are $20,000 and they're going to be made up of $10,000 in salaries and $10,000 in rent. The first thing we can do is allocate costs in their entirety to the different departments. So we've got pressing and packing. Those are our production departments, and then we've got the canteen, which is a service department or a cost centre. Now all of those 10,000 salaries have been allocated in their entirety to the three different supervisors because they all work in different places, so we can put those where they work straight away. So there's no need to do any sharing out there. However, the rent we can't actually deal with in that way. What we've got to do with the rent is we've got to apportion it. Now, we've got to apportion it based on some kind of fair way, and the best way to do it is based on floor area. So we've shared out our $10,000 in rent based on a total of 1,000 metre squares of floor space. So if we take the pressing department, what we would have done here is we'd have said we've got 600 out of 1,000 multiplied by 10,000 cost, and that gives us $6,000. And we've done exactly the same for the other two. Now at this stage, we've actually also apportioned it to the canteen. So regardless of whether we've got production or service cost centres, we're going to apportion cost to all of them. Now, CDs don't actually flow through the canteen. So what we need to do is get all of the overhead costs into the actual departments where CDs actually flow through them. And that means we're going to reapportion the service centre costs to the production centres. So we end up with all of the costs in the two production departments. Now the method that we're going to use here is called the direct method, and that's going to assume no inter-service cost centre work. There can't be, because there is only one service centre. So they can't service each other when there's only one service centre. Where there is more than one service centre, let's just say we had a canteen and a maintenance department, then we may decide that we want to recognise some of the inter-service work. In other words, that the maintenance does work for the canteen and the canteen also does work for the maintenance. Now we might do that using what we call the step method, and what we do there is basically start with the largest and apportion that first, and once we've done that, including to the other service department, we'd then put it to the production cost centres. The reciprocal method is a more accurate but a much longer winded way of doing it, where we basically do what we call repeated distribution until we've much more accurately apportioned all of the service centres to the production cost centres. So this is the direct method. What we've done here is we have taken the costs, what we've got at the moment, and then you can see that we've taken the canteen and we have shared it out between pressing and packing. And we've done that based on the number of employees. So canteen costs, number of employees, that makes sense. So we've got 80% of the employees are in pressing, 20% are in packing. So that probably reflects their usage of the canteen. Now you can see that all 20,000 of the overhead costs are all in pressing and packing. And the CDs flow through those, and that's what we need for the next stage. The final stage then is to absorb the costs into the cost units, and we'll look at how we do that later. In lecture example 1, we're going to look at allocation and apportionment. Let's have a look at the scenario. The management accountant of the Crazy Cake Company is preparing some working papers. Now they've got two production cost centres, mixing and stirring, and two service cost centres, stores and maintenance. The directly attributable production overheads have already been allocated to the relevant cost centre, but other costs need to be apportioned. A section of the information being used is shown below, and you're required to establish what items need to be entered in the boxes A, B, C and D. So we can see we've got A, B, C and D here. We've got underneath stirring, we've got the apportionment of rent. The basis of apportionment for human resources in B, and then we've got D, we've got the mixing value for equipment depreciation, and C, we've got stirring again, but this time the value we need to have for human resources. We've also been given some other information, and this is going to help us to do these apportionments. So let's start with A. Here we need to work out how much of that 1125 is going to be apportioned to stirring. So let's have a look at the information that we've got. It makes most sense to use area to apportion the rent. So the first thing we need to do is total up how much there is in the whole of the organisation in terms of area. And that all comes to 30,000 square metres. So in stirring, there's 9,000. So the amount that we need is 9,000 out of a total of 30,000, and we're going to apply that to the 1.125 million, which is the rent cost. And that gives us 337,500. And that's going to be what we need in box A. In box B, we need to decide the basis of apportionment. So what method are we going to use to apportion the human resources costs? Well, looking at the choices here, it would seem that the closest we can get is the number of employees. So all we need in there is employees, the word employees. C is looking at the stirring department again and saying, well, how much of this $90,000 cost are we actually going to apportion to stirring? We've said we're going to use employees, so let's total up how many we've got. And that comes to 450. So 180 of them are in that department. So we've got 180 over 450 multiplied by $90,000. And that comes to $36,000. And that's what we need in C. Finally, D. This time we're looking at mixing, and we want to work out how much of this equipment depreciation cost is going to be apportioned to the mixing department. Now we're told it's going to be done on the net book value of equipment. So let's add up the total net book value of equipment, and that comes to 3.5 million. So as before, we're working out how much is in mixing, which is 1.8 million. So 1.8 million over 3.5 million, just dropping off the 3 zeros there. And if we multiply that by the total cost of $200,000, then we end up with $102,857. And that's what needs to go in box D. So the final stage then is called absorption. And for that, we're going to calculate an absorption rate. Now, this is a very important formula that you're going to use a lot throughout this whole topic of P1. So what we've got on the top is we've got the estimated overhead costs. On the bottom, we've got the expected or the normal activity level. So let's just say at the moment that's units. Notice that this is estimated. So this is a predetermined overhead absorption rate. So we're actually going to do this at the start of the period and not the end. And we'll look at the implications of that later. So let's just go back to our CD factory for a moment. What we've got here is production of 20,000 CDs that have been budgeted. Now, the totals that we came up with was for pressing $13,200 and for packing $6,800. So remember, there was $20,000 in total in our overheads. So that's how the split ended up. Now that means that we can calculate overhead absorption rates for each of these different departments in the factory that the CDs pass through. So all we need to do is take our estimated overhead cost and divide it by the normal or expected level of activity. And you can see that we've done this for pressing, and we've got 66 cents, and we've done it for packing, and we've got 34 cents. Now, added together, that means that comes to $1. And that's how much we're going to add to that cost card. So in summary then, the direct costs don't give us a problem. They came to $5 a unit. So we're going to sort them first. But this chapter is really concerned with indirect costs. So first of all, we allocated what we could to all of the cost centres, regardless of whether they were production or service. We then apportioned what we couldn't allocate directly using some method of apportionment that was fair. Once we've got all of the costs in all of our cost centres, we're then going to reallocate and reapportion our service cost centres to the production cost centres. And eventually we absorbed those into the cost units. And we ended up with our costs of our CD for each of the cost centres there. So our cost card now, we can fill in the bit that was missing before, and our total production cost comes out at $6 for each CD. In this section, we're looking at other bases for absorption into production. Instead of just using units, we might use something like labour hours or machine hours. If we had a particularly labour-intensive cost centre, then it makes more sense to use labour hours, because maybe labour hours is the thing that's causing the overhead. Or more machine-intensive, we might use machine hours instead. These are the three that you'll come across most in any exam questions. However, you also need to be aware of the other three. And this is looking at the overheads as a percentage. So you can see here we've got either percentage of direct materials cost, direct labour cost, or percentage of prime cost. Direct labour hours and direct machine hours, however, do take into account that time and time-related overheads are perhaps more important than just relating them to a cost. Now in IAS 2, International Accounting Standard 2, to do with inventory, it specifies that the basis that we choose should bear some reasonable relationship to the product. So let's go back to our CDs and now introduce another product, which is DVDs. Now, with DVDs, it's going to be more appropriate to absorb fixed overheads on a per direct labour hour basis. So let's just have a look. Remember we got to a total of $13,200 for pressing and $6,800 for packing. Now, if we look at the DVD product, we can see it uses 1 hour of labour, whereas packing uses just 15 minutes. CDs use 15 minutes in pressing and 15 minutes in packing. Now, if we take into account all of the labour hours that are used within the pressing cost centre throughout a whole year, then what we've got is a total of 12,500. And that's production of 10,000 DVDs and 10,000 CDs. So if we multiply 10,000 DVDs by the 1 hour, we come up with 10,000 labour hours. If we produce 10,000 CDs by a quarter of an hour, then we get 2,500. So a total of 12,500 labour hours in pressing. Now in packing, we've only got quarter of an hour for both of the products. So only 5,000 labour hours this time. Now this is going to give us a different cost, overhead cost, for each of the different cost centres than we had before. So you can see if we take $13,200 divided by the 12,500 labour hours, that's $1.06 in pressing, and 6/8 divided by 5 gives 136 per labour hour in packing. So let's see how we put those into the products themselves, starting with DVDs. So all we do is we say, well, in pressing, it takes 1 hour, and we've calculated the overhead absorption rate per hour as $1.06. Then it goes into packing, where it spends 15 minutes, and that's at a rate of 136. So that gives us a total for each DVD of $1.40. Now, in contrast to that, remember, the CDs used less labour hours, so only 5,000, so less than half. So when we're absorbing the overhead into the products, here we've got quarter of an hour at 106, quarter of an hour at 136. So we end up only with $0.6 per CD. So what we end up with is less overheads assigned to the CDs because there was less labour hours. So if labour hours are the thing that's actually causing the overhead, then that's a fair reflection of the actual cost they should have. DVDs take a lot longer, and therefore we've got more overheads assigned to those, and therefore the cost is higher. In lecture example 2, we're asked to determine the most appropriate overhead absorption rate for cost centre X. Now, we've got two cost centres, X and P, so it's cost centre X that we're going to look at in lecture example 2 to start with, and then we're going to do the same for cost centre Y. Okay, so let's start off with X. Now, the first thing to do here is to have a look at the overheads, and we've got our overhead amount there of $50,625, and two of the different ways that we could assign this are hours. We've got labour hours and we've got machine hours. Now we've also got direct material cost and direct labour cost. Now let's have a look at these overhead absorption rates and see which one of them actually looks like the most appropriate. Now as we look at cost centre X, we can see straight away that it is more of a machine intensive cost centre. There's many more machine hours worked or used than there is labour hours worked. So we're going to pick machine hours. Let's just make sure that that works. So we've got $50,625, and if we divide that by 67,500 machine hours, we end up with $0.75 per machine hour. So D is the correct answer. Now you may wonder why we haven't picked the direct materials cost or the direct labour cost, because the overhead is actually 50% of the direct materials cost and it's 300% of the direct labour cost. Now, if it's machine intensive, then the labour cost and the materials cost are not going to be particularly relevant. But the other issue is that the cost is not equal to the time. In other words, with machine hours, the more time that goes over, the more machine hours will be used, and therefore the more cost will be incurred. That's not necessarily the case with labour and materials. Okay, let's have a look at the other cost centre, which is actually cost centre P. So let's have a look at this one. We now have got more labour hours than we have machine hours, and therefore we've got $18,000 divided by 37,500, and that gives us an answer of 48 cents per direct labour hour. In section 3, we're going to look at over and under absorption. If you recall, when we worked out our overhead absorption rate, what we did is we took our best estimate of what our overhead expenditure was going to be and our best estimate of what our activity would be. Now that might be units, it might be hours, either labour or machine hours. What we then do as we go through the period is we absorb overhead based on that overhead absorption rate, and we apply the actual activity level to it. Now, the problem that we have is that may not be the same as the actual overhead that we incur. So in other words, we've got this estimate maybe a little bit wrong. Now, that results in what we call under or over absorption. If we've absorbed too much overhead into our cost of sales, then that means we've over absorbed. If we haven't absorbed enough, then it means that we've under absorbed. Now, at the end of the day, our costs that we charge to profit have to be what we've actually incurred. So what we do with this under or over absorption is if we've under absorbed, we deduct it from profit, and if we've over absorbed, then we add it back to profit. Now, if we get the top part of that overhead absorption rate wrong, then this relates to something we call an expenditure variance. It causes an expenditure variance. And this is when our actual overhead expenditure differs from our budgeted overhead expenditure. If we get the bottom part wrong, then that is a volume variance, and that then relates to the volume being different to what we expected. Now, we'll be looking at these later in the course when we're actually going to calculate those variances in more detail. So let's have a look to see how this is going to work with our CD example. Now, if you remember, the budgeted overheads in our CD example was $20,000. And if we made 20,000 CDs, then the overhead absorption rate is $1 per CD. So that is our predetermined rate. So we're going to complete the following to see what would happen in two different circumstances. The first one is where the overhead expenditure turns out to be slightly higher, $21,000. But we still produce 20,000 CDs. In other words, we've got the top part of the formula wrong, but the bottom part's still okay. So let's work out the over or under absorption. So we know that the overhead that's actually incurred is $21,000. We're going to compare that with the overhead that has been absorbed. Now for this we need to look at the actual level of activity, which in this case is CDs, multiplied by the predetermined overhead absorption rate of 1, and this gives us $20,000. Now, because the overhead incurred is more than what we've absorbed, it means that we have under-absorbed by $1,000. And that means that we're going to have to take that off our profit figure. In the second example, we're going to consider, well, what happens if we got the top bit right? So our actual overhead was $20,000, but we made more CDs than we planned. We made 22. So the overhead incurred is $20,000, but this time we absorbed more. We've got 22,000, and multiply that by our overhead absorption rate gives us 22,000. This time, because we've absorbed more, we have over-absorbed. So it's $2,000 over, and this time we'll add that back to profit. Section 4 goes into quite a lot of detail about how to prepare an income statement under absorption costing. Now, in the exam, you're not going to have to prepare a full income statement from scratch, but we're going to do that because it's the easiest way to actually go through the principles behind this preparation. Now, the first thing to notice here is that the split between the top half of the income statement and the bottom half is about production and non-production costs. So right the way down to gross profit there, this is all our production costs. And that little bit at the bottom down to net profit then is our non-production cost. So we start with sales, we then take off our cost of sales, and key things to note here is that the inventory is valued at full production cost. So it's going to include an element of our fixed production overheads. Our actual cost of production is going to include not only the variable costs, but it's also going to include the fixed overhead absorbed. And we're going to adjust it for any over or under absorbed overhead. So at the end, we're going to end up charging our cost of sales with the overhead that's actually been incurred. Once we've got to our gross profit figure, all we need to do then is take off any costs which are not to do with production, and we end up with our net profit. So in lecture example 4, we're going to put together an income statement under absorption costing. Let's just go through briefly the information we've got. We've got information about selling price and variable costs per unit. Notice the variable costs per unit include some selling and distribution costs. So we don't want to include those in our cost of goods sold. That's going to be further down the income statement before we get to net profit. We've also got some information about our fixed costs. So we've got our budgeted and our actual production overheads and selling and distribution. So let's just make a note that they also need to be further down. We've got activity levels for years 1 and 2. We're going to do both years, but we're actually going to only do working papers for the first year. So we've got budgeted production, actual production and sales. And we're also told that there is no opening inventory in year 1. So first year then, year 1, some of the information has already been partially completed for us. So let's start off with the sales figure. So let's get the information we need. We actually sold 4,200 units at a selling price of $10 a unit. And that gives me $42,000. So next we need to put together the cost of sales, and we've been told there's no inventory. So the first working is about variable costs. So let's work out the variable cost per unit to start with. Remember, we're only interested in production variable costs. So we've got some labour, materials and variable overhead, and that comes to a total of 6. So we've got a total of 6 per unit. And the production is 4,400 units. So our first working 1, we can fill that in. We've got a variable production cost per unit of 6 multiplied by 4,400 gives $26,400. So we can put that into our statement, 26,400 there. But because we're doing absorption costing, we also need to include an element of fixed cost. So we've got a little bit of work to do here to complete working 2. Now we need to work out how much is going to be absorbed. So the first thing we need is our overhead absorption rate per unit, and that's the budgeted overhead over the budgeted production. So the budgeted overhead is $8,000 and the budgeted production is 4,000 units. So we've got an overhead absorption rate of $2 per unit. Now we know that we've produced 4,400 units, so we'd have absorbed $8,800. And we can pop that into the cost of sales. So next we need to see whether there's been any over or under absorption. Now it turns out the actual overhead incurred was 8,500. So in working 3, let's calculate the amount of over or under absorption. Now the overhead absorbed was 8,800, and if we take away the overhead incurred, then that was 8.5, and that means that we've actually over absorbed by 300. So we've got 300 over absorption. Now that means that we need to take it off our cost of goods sold because we're effectively adding it back to profit. That just leaves the closing inventory to work out, and that's going to be done in working 4. So we've got opening inventory of nothing. If we add in our production, which was 4,400 units, take off our sales of 4,200 units, then that leaves us with a closing inventory of 200 units. Now we need to value this inventory. So we're going to do that based on full production cost. Now that means the full variable cost of production, which we said was 6, but also the fixed overheads, which we worked out was 2. So the full cost of production is 8, and that's going to come to a valuation of $1,600. So that also needs to come off the cost of goods sold. So that should all come to 33,300 cost of goods sold, which it does. So the gross profit is 42,000 minus that, which is 87. And all we've got left to do is the non-production cost. So the first one is the variable selling and distribution, which is in working 5. Now this is variable, but it's variable against the sales units. Now we actually sold 4,200, and the selling and distribution variable cost is $1 a unit. So that's 4,200 in total. So let's pop that in there. And finally we've got our fixed selling and distribution, which we're told was $2,000. And that should all come to $2,500 net profit, which it does. Okay, moving on to year 2. Well, this time the sales have been done for us. We've got 4,000 units of sales, and the opening inventory is going to be our closing inventory from the previous period. So that's going to be 1,600 that we bring forward. Now the production in period 2 is 3,800 units. So the variable cost was 6. That gives me a production cost of 22,800 variable. And the fixed overhead absorbed will be 7,600. Next is the over or under absorption. So the actual overhead is 8.5, same as before. Compare that with what we've absorbed, and this time we've got a difference of 900. Now that 900 is actually under absorption because we haven't absorbed as much as what's been incurred. So this time we are going to add that to the cost of goods sold and therefore take it from our profit. Next we've got our closing inventory. Well, let's think. We had 200 opening. If we add in what we've produced, which is 3,800, that gives us 4, and we've sold them all. So we end up with no closing inventory. That all comes back to a cost of goods sold of 32,900 giving us gross profit of 7,100. If we take off our variable selling and distribution costs, so this time it's 4,000 times 1 for the selling and distribution costs, the fixed overhead for the selling and distribution costs, we end up with net profit of $1,100. We finish off by looking at some advantages and disadvantages of absorption costing. The first one is to do with selling prices, and it does recognise that in order to make a profit on something, or at least break even, you do have to cover all costs in the long run, so all the variable costs and all the fixed costs. This is in contrast to marginal costing or relevant costing that we'll be looking at later. The second advantage is it complies with the International Accounting Standard on accounting for inventory. Now, the problem is if we don't use this system to do our management accounts, somehow we've got to reconcile it back to a system whereby we do include an element of fixed production overheads to produce our financial accounts, and that's going to be problematic. However, there are a couple of quite important disadvantages, and the first one is that profits can be manipulated. How can they be manipulated? Well, simply by changing production levels. What we can see is that in our closing inventory, we've got an element of fixed overhead. Now, the more closing inventory that we've actually got, the more fixed overhead we've got in that closing inventory. Now, remember that in the cost of goods sold, we take our opening inventory, we add on our production costs, but then we take off the closing inventory, and that cost goes into the next period. So the higher that cost is, the more is going to come off your cost of goods sold, and that means that your profit is going to be boosted. Now, it is only going to be a temporary adjustment, but if your bonus is being awarded at the end of a particular month, then it's something that you might do just to purely manipulate the profit figure. The second disadvantage here is to do with the assumption that we make about overheads, and that's that overheads are volume related. Think about units, think about labour hours, think about machine hours. Those are the ones that we're going to use most of the time to absorb overheads. Now, that means that the more volume that we actually make, the more labour hours, the more machine hours, the more units we produce, the more overhead is going to be absorbed. What we'll see later is that many overheads are not related to volume at all. They're actually related to complexity of product and diversity of product. And that means that really we need some different techniques. And we're going to be looking at activity-based costing as a different form of absorption costing, if you like, a more sophisticated form of absorption costing that allows us to address this issue. In lecture example 5, we're given 4 statements, and we have to say which, if any, of these statements are true. So let's just have a look at the first one. Companies can choose whether to use absorption costing in the preparation of their accounts. Well, this is actually true. Companies can actually choose whether to use absorption costing. If they choose not to, though, they're not going to be complying with IAS 2. So if they use another system, such as marginal costing, which we'll be looking at shortly, then it means they're going to have to do some reconciliations. In their financial accounts, they must include an element of fixed production overhead. So most companies do actually choose to use absorption costing in the preparation of their accounts so that they don't have to do these complicated reconciliations at the end. But it's still a choice. The second statement there says by setting a selling price based on full absorption cost, we can be sure that we will recover all of our fixed overheads. Well, that's actually not true. Unless we actually cover all of the activity and we get the cost exactly right and we sell enough, we're not going to cover everything. Remember, when we set an overhead absorption rate, we estimate what the activity will be and we estimate what the cost will be. Now, that will give us an overhead absorption rate, let's just say per unit. If we use that set a selling price, we're only going to recover all of that overhead if we actually sell enough units. So even though absorption costing does recognise the fact that we do need to cover up all of our fixed production overheads in our selling prices, then we still need to make sure we sell enough in order to make sure they're all fully recovered. The third statement there is also not true. Absorption costing won't always result in a fair allocation of production overheads to products. Where the cause is not actually linked to the overhead, then it's not going to be a fair allocation and apportionment. So we'll be looking at diversity of product and complexity of product. When other things apart from volume drive the overhead cost, then it means that we're going to have a different allocation. And finally, absorption costing can result in dysfunctional behaviour by managers. That is true. We've seen that we can have inventory building towards the end of the period, and that would be just to manipulate profit levels. Now you might say, why is this dysfunctional? Inventory causes holding costs if we can't sell it. So it's going to cause extra costs for the organisation, and therefore it's dysfunctional.